Oh, we're live, we're recording. Yo, welcome to Infinite Investors, the home of new and non-investors. I'm Curtis, and today we got another portfolio update. Sorry for the psychopathic laughing at the beginning. I was just looking at my portfolio again, and you know what? You've just got to laugh. It's been a very funny week. It's been a very interesting week, and yeah, we've got lots to get through this week. So obviously, I'm gonna give you a lovely breakdown of what's been happening, what's been going on with my portfolio specifically as well, and what my plans are for the recession, new buys that I might be doing, and just general stock market news and information. So it's been a very, very, very dark day, and it's probably gonna get darker for a while. It's been a dark week, to be honest. This week I was laughing because this week I added £500. So my last portfolio update, you saw that the balance was 13,150. I added £500 to that, so that's obviously taking it to 13,650, and it's now less than what it was at the time. It's now less than last week. That's so funny. It's not funny, it's terrible, but it's just a sign of the times, really. So I put £200 in LNG, as you can see here on the 14th. And obviously it's continued to go down, but I've got some great news for people that have invested in LNG. I put £200 also in Aviva, as you can see here on the 14th, and that's continued to go down. And then I also put £100 into Sentiment. As you can see, it's not going down, which is great. It's just averaged down my percentage a little bit just because I'm buying a bit higher, but it's still in the green, which is phenomenal. So all that money has ghosted, all that money has disappeared, but I get £20 in terms of dividends extra in my September dividend payment. So, that's going to buy me a Vapiano. Probably not for whoever I go with, though. They're going to have to buy their own Vapiano, but at least I can get my own. So, that's good enough. That's good enough. But yeah, I've made a lot of videos since the last portfolio update last week, so I just want you guys to go and check those stuff out. Yesterday I made a video, 7 ways to make money in a recession, so definitely go and check that out. I think it's going to be a really, really valuable video, and it will give you hopefully 1 or 2 tips of things you can do during a recession. And I've been good to you. I've put a video out on improving your average dividend yield, which is going to be crucial during this time as well. I put a video on my analysis of Freetrade's new 25 stocks last Friday, so that gives you which REITs that I think are my personal best picks. I did a small trailer, which is minor. It's minor, but it's just for new people, and just to know what's really good with the channel and what this channel is about. So I thought, let me make sure that that's up there. And then obviously there's been a 2-part recession series. So part 1, I was talking about the stuff going on with Germany, UK, US, etc., and I alluded to some of the strategies there. And then part 2 yesterday was what I've just mentioned, is the recession strategy. So go and check that out. But yeah, today I've got a portfolio update, and if you want to know more, please like, please comment, please subscribe. On a mission to get to 2,500 subscribers and get the world of investing out to more people in a clear, simple and transparent manner. But first, let's get busy. Today I am at an L. I'm taking an L for about £719. So I'm about £719 down in terms of capital gain, which equates to roughly 7.33% loss in total. Not roughly, accurately 7.33% loss in total. The good news is that my dividends is returning at the moment, year to date, 2.5%. So it is making it, a little less worse rather than me losing about 10%. So, thank God for dividends. They are currently a bit of a lifesaver, and that's something that I think, if you're not a dividend investor, you should definitely consider, particularly during, the recession time when it does come, what dividend stocks you're potentially going to go and look into. So if I'm really honest, I'm down £719, but I'm actually not too fussed with the current state of my portfolio. I know that it is not to do with my stock choices. It's not to do with bad stock buys. It is a macroeconomic global issue, and there's nothing you can do about that, and that's just part and parcel of the market. And to be honest, I smell BO, and it's not because I haven't had a shower yet, it's because it stinks of a buying opportunity. There is an absolute plethora of buying opportunities currently in the market at the moment, which I'm going to be talking to you about. And so the only consideration for me personally is timing, because, I do think that stocks will continue to fall for the time being. And so, I'm not going to just go and do another interim update next week and have that all get sucked out again. Do you know what I mean? So really and truly, I will have to time it a bit more strategically. However, I do think there's definite buying opportunities, because if you look at the fundamentals of a lot of these companies, they're really, really good. So obviously the red is nothing that, the company is doing wrong, specifically, which is obviously a great thing. One thing to definitely note is that I will absolutely continue with my dollar cost averaging on a monthly basis. I will continue with that. I'm never going to stop that. That's something that's going to naturally always continue, irrespective of if it goes up or down. And because it's going down at the moment, it means I'm buying at a cheaper price. So it is a good investment for me. Now, I was considering upping my dollar cost averaging to about 1,500 a month. But it'll definitely be within the 1,000 to 1,500 a month. It'll just depend on what opportunities present itself. So the minimum I will continue to do is £1,000 a month. The maximum I will probably do is £1,500 a month, unless there's some crazy opportunity that I think I want to get particularly involved in. But let's get into some of these sectors. At the top right here, as you can see, is the insurance sector. Lord have mercy on insurance. And the funny thing is, Aviva, when we look at Aviva, Aviva's earnings per share went up 2% in their last earnings update, their half one earnings update. Operating profit was down, but that's primarily due to market conditions, which they've announced themselves. That's not my analysis, that's their analysis of it. So that's, to be honest, really, really understandable, if I'm honest. So, earnings per share going up is a positive sign. It's just the market conditions is being really strong in terms of, counteracting that. From an L&G, legal and general standpoint, their pre-tax profit rose to 1.05 billion. That's an 11% rise, which is a phenomenal amount. I can't even speak. Phenomenal amount of growth. Their earnings per share grew 13%, which again is just great. I mean, in a typical day, on a typical, Tuesday or Wednesday or whatever day it happened, you would just see legal in general soar up because of a positive earnings like the one I've just mentioned. However, because the market is extremely depressed at the moment, emotionally and financially depressed, then that is the reason why it just continues to go down. So I do think that legal in general is a significant buying opportunity, probably the best buying opportunity of any of the stocks that I currently hold. It's extremely undervalued, and it's something that I will definitely continue to invest in. The only negative from their earnings update is that their debt increased 11 million to 108 million, but that's about a 10% increase. It's not the worst, but debt is covered by short-term assets, which is great, and that's about a 10.4 multiple. So if there is a recession, they have more than enough money to be able to ride through it. But they're down 12%, and when I say 12%, it's down 12% for me personally. I talk about the time that I last invested, not this interim round, but the last round of investment till now. And so it's down 12%. And again, that is purely on a macroeconomic situation. But I do think that legal in general is a good buying opportunity. And so it's something that I'm going to continue to invest in. And I'm going to just take this opportunity to continue to invest, because, currently I'm losing £200 there, which is horrible. I'm losing, how much am I losing in Aviva? £200 there again. So for me, these are buying opportunities. And I'm just definitely going to continue to invest as per normal. If we want to go into banking just continues to perform poorly. We can see that Lloyd's 15.818% down for me. So that currently is 210, so another £200 there. Barclays, where's Barclays? There you are, 12.67% down, about £81. The days when £81 to me, an £81 loss, would keep me up at night. And now I look at £81, oh, it's just £81 just because I've got £200 losses everywhere else. It's so funny how, it can actually just change your perspective. But listen, yeah, £81 loss, 12.67%. And CYBG, looking more like CITV than CYBG right now. This is a 30% loss. However, it's not more than some of my other stocks in terms of the volume, the amount, only because I didn't have that much invested into CYBG. But for the amount I had invested, it's still a considerable amount. However, again, good news within the banking sector. According to Simply Wall Street, you've got Lloyds and Barclays that are both 47% undervalued at this current moment. So I do think there are buying opportunities, and I do think that they will bounce back from this recession as well. And CYBG is 55% undervalued. So again, I personally think that these companies are still decent companies to invest in. I have no significant concerns with the companies. And I'm very, very transparent. Guys, I've sold stocks where I didn't believe in a company no more, where it's Man Group, Weibo, etc., etc. Actually, Weibo wasn't really about the company. It was more because I didn't really want to have two accounts. But if I don't believe in a company, I'll tell you, and I'll say, look, I don't believe in it no more. And I'll find a way to get out of my portfolio, probably by averaging it down to like a £10 loss and then just selling it at a very, very minor loss. So and that's really a trading tactic. It's not something I would actually recommend anyone to do, but that's probably what I would do in any of those situations. So to be honest, I still see them as buying opportunities, which is the reason why I'm going to continue to hold them into my portfolio and invest into them for the long term. If we move over to US stocks, so Chevron, as you can see here, is 5.48% down for me since the last time I invested, as you can see. But obviously I've invested at some decent prices before, so it's only 1.73% down in total. Verizon is only 1.3% down for me since the last time I invested, and as you can see, it's 2.28% up, a nice little £7. And also with a lot of these American stocks, I'm benefiting from a currency gain standpoint. So if I do sell this, I'm making like an extra couple of quid just because the UK pound has performed worse against the dollar. So that is a slight benefit of US stocks and something to maybe consider with your current portfolios as well. Facebook is it was just being a bit delayed there. Facebook is 8.5% down for me at the moment. Since the last time I invested, only 2.71% down overall. So there's a potential buying opportunity. But to be honest, I don't see 2% as buying opportunities. Buying opportunities for me is definitely double digits. So I'm looking at 10% upwards as significant buying opportunities. However, if it's down, it's down. And obviously it's better being down and overfunding or buying more than being up. Then you might as well just hold at that point or sell and sort of claim that profit. First Solar, which has been probably pound for pound my best stock, to be honest, this whole year, is currently down, and it's down 3.16%. But since the last time I invested, it's down 9%. But I completely still believe in this business going forward. I think the growth potential for this business is significant. Some of the markets that they're expanding to just presents a lot of opportunity and a lot of headroom to really win in this space. So you know what, again, a lot of this stuff you're going to see me or hear me repeating myself, that I don't think there's nothing wrong with a particular stock. It's more macroeconomic issue. Snapchat is the only one that's kind of held up. However, it's down the worst, 10% for me, but it's held up just because I bought at decent prices earlier on, making a nice little £6. Again, I could get maybe, I don't know, maybe a supermarket. I don't know. I can get maybe a drink with that. I don't know. At the end of the day, I'm just going to hold on to that. I haven't got that much invested into Snapchat, only £91 compared to some stocks where I've invested like probably 2k or just shy of 2k. So this app is slightly freezing. It's not me. So as you can see, if it freezes, I apologize. But on average, my US stocks is down about 7%. So I think they'll continue to go down further. So I'll wait that out, and I probably won't contribute to them until my next normal round of investing, which won't be until the end of the month. Let's scoot over to housing. So housing, we've got Taylor Wimpey, 13.9% in the red, but Taylor Wimpey's 18% down since the last time I invested. So again, that's a bit of a significant drop. Taylor Wimpey is the highest dividend stock in my portfolio, currently sitting at about a 12% yield. I think their next ex-dividend date is probably somewhere around November, somewhere along those lines. It's towards the end of the year, October, November perhaps. So I'm definitely going to try and scoop up more shares because they're probably going to pay the best dividend but when the year ends, because obviously, dividend yields vary based off your current share price. Now the share price is down, so that's why the dividend yield is probably a bit higher, but even before, it still had the highest dividend yield. So I'm definitely going to add a bit more to Taylor Wimpey and try and maximize that, seeing as dividends is the only thing that's kind of keeping me up at the moment. Barrett is 7% down, but the good thing about Barrett is that Barrett is still in the green. It's been, again, pound for pound with First Solar, probably my best stock. I'd probably say it is probably my best stock. Definitely best UK stock, and probably pound for pound my best stock overall. So Barrett, I have no concerns with Barrett. We know that their performance, their earnings update was phenomenal. They've done extremely well in terms of, all of the metrics that they measure in terms of their performance. And that was only 3-4 weeks ago that they announced their earnings update. So to be honest, if they're announcing their earnings update and it's been phenomenal in terms of their actual books and they're going down, it's again due to a market issue and market concern. And I don't sell on the way down, I buy more on the way down. That's the way that I approach my investment anyway. And also Barrett is still undervalued by about 31% according to Simply Wall Street. So for me, it's still a great buying opportunity. In terms of my funds, you guys know that I hold Trig, which I haven't invested that much into, to be honest. I only put a little bit amount into it recently just because of the ex-dividend. I think Trig is paying about a 5% dividend yield, so I put a small £25 in there. Nothing major in terms of the context of my overall portfolio. I had some extra money over, so I just put that into Trig. That's about 2% down. My Jpmorgan Fund, which to be honest, I'm really excited about during the recession, just because I looked at this fund's performance during the last recession, the 2008 recession, and it rid it perfectly well, and it managed. You won't be able to see it or go far that back in the free trade, but just look at the graph. I don't think the actual fund is a bad fund. I think it's a well managed fund. A little bit on the higher side in terms of price, but I'd rather pay a bit more of a premium to know that I'm getting a premium product that's actually going to perform. So I'm going to probably index a bit more money into this fund over the course of the next few months if we do dip into a recession, just because I believe that once we get out of the recession, this fund will bounce back significantly well, and maybe be on its journey towards a £20 per share price. So I might make a nice little 50%, depending on the time frame that I'm currently looking at. Msci China, again, this is a fund that I haven't put that much money into. All I did was sold Weibo, and then I put that money into here, and I've kind of left it. I've not really added. Last time I added was little £6 here and there, and then I haven't added that much money to Weibo. The long and short of it is, into Msci China. So will I add more money? Absolutely. I would definitely add more money into this, but I think because of the whole trade situation, I just expect it just to go down, and I'll wait until I think this potentially can bottom out before I start actually going a bit more heavy into Msci China. But currently I only got 50 quid, so in the grand scheme of things, in the whole context, it's not that bad. And then S&P 500 is still in the green. I consider S&P 500 the market benchmark. That's my personal market benchmark. I know some of you guys might have other market benchmarks, but definitely for me, it's the S&P 500. That's what a lot of analysts use as their benchmark. When we look at compounding interest and how to be a millionaire by the time that you retire, typically we look at the S&P 500 in terms of its performance over the last 10, 20, 30 odd years, etc. Currently, the S&P 500 is still up 4% for me. But obviously it's gone down recently about 3% for me specifically. Now, this is my retirement fund. So I'm going to just keep on going into it heavy. And when stocks start to fall, when this fund starts to fall, I would definitely overfund S&P 500, because it's just something that if everything was to go to the toilet, S&P 500 I think will just continue to rise in the long term. So if I ever wanted to stop being an active investor and I wanted to become a passive investor, because I wanted to value my time off and take up kite surfing or tobogganing or whatever, do you know what I mean, rock climbing or abseiling, if I wanted to take up a new hobby, then I would just invest in S&P 500, personally speaking. That's what I personally would do, but obviously everyone is going to be different. Now, In terms of the recession plan, as I mentioned yesterday, I put up a video in terms of 7 ways or strategies to deal with a recession. I've had a very, very long, hard think about how I'm going to plan and deal with this recession. What's going to be my strategy? What's going to be my plan of attack? How am I going to approach the situation and try and maximize? So I'm actually going to take a bit of a hybrid approach through some of the strategies. I'm not going to go through one single strategy, but I am going to take a hybrid approach. One of the things I will do is stockpile cash. I've always mentioned that, and I'm just going to continue to save. I know I won't make no interest on the cash. The goal is not to make interest on the cash, but just to have a lot of liquid there, because you never know what's going to happen in the future. But when I do feel like it's bottoming out, and there's a positive sentiment in the market, then I will dump a whole bunch of cash in. Now that could be at the beginning of 2000, which will be fine for me, because I'll pick a few growth stocks that I think are highly undervalued, that are significant growth stocks. I won't even dollar cost average those stocks. I'll just drop that cash that I stockpiled throughout the remainder of this year. Maybe if that happens at 2020 January, and then I'll leave it till the end of next year and hopefully make, good 50, 60, 70% or whatever the rate will be on that. And if you're questioning whether that's possible, it's definitely possible. I did a video on if I actually stop dollar cost averaging and just put the money in up front with some of my stocks, and you can see with First Solar I would have been about 40% up. With Barrett I would have been about 60% up. With Vodafone I think I would have been actually no, Vodafone probably like 15% up. So anyway, the point of the matter is, sentiment, I was already 40% up last week before I added this extra amount of money. So when I say like getting 50% at the end of the year, if 2 or 3 or 4 good stocks can definitely do that for you. Obviously you won't get that across all of your set of stocks, but that's the reason why you diversify. So to be honest, that's what I'm probably going to do. Strategy number 1 is stockpile cash, and then when it comes to the beginning of next year, depending on how long the recession is, when it comes to any point where I feel like the recession is bottoming out, whenever that time is, I will then lump some into what I consider will be high growth stocks and just ride that out until I get a decent return. What I'll also do is keep investing in my current strategy. So I will not stop investing at least £1,000 a month. I will always put that into the market, even if I buy it tomorrow, and then let's say tomorrow is my round of investing, I buy it tomorrow and then the share prices all drop by another 3%. Cool, they drop by 3%, and then the following month I'll do it again, and I'll do it again. And my goal there is just to get as many shares as I possibly can, so that when I am starting to get dividends, particularly that this is an ISA and I don't pay any tax on capital gains or dividends, hopefully at some point in a year and a half, I will be getting more than £2,000 in dividends on a year, or I'll be getting more than £100 dividends on a monthly basis. And then obviously I won't be paying any tax on that, and that'll be a nice passive income stream. So I'm definitely gonna do that. But one thing I will do is I will start shorting the market. As you guys know, I use eToro. I've been using eToro before I joined Free Trade, and I'm going to try and profit from the down cycle. So I'm going to put a little bit of play money, some what I call play money, just some play around money to try and short either different stocks or just short the index in general. Obviously I'll be shorting those CFDs, and then obviously try and make some money on the way down as I would on the way up typically as well. The last thing I might do, which is the last thing I want to talk to you about today, is buying some recession-proof stocks. In the video I talk about recession-proof stocks, typical things like consumer goods, but also some like fast food chains and those types of stocks as well. So I am going to start researching some particular stocks that I might think are recession-proof, some consumer goods stocks, and if they at least meet my criteria, they don't have to be fully in the wheelhouse, but if they're very, very close to my criteria in terms of what I look for in terms of being undervalued, level of debt, PE ratios, PEG ratios, etc., then and only then I will add them into my portfolio, put a small amount of money into there in order to hopefully gain a bit of a return, maybe some dividends during that. But I don't know how much I'm going to sort of expose into that and how much I'm really going to do. I haven't thought. I might do none. I might do my research and realize, what, I don't want to do that, and I'm quite fine with just the other 3 strategies. But yeah, there are 7 strategies, so go and check that video out. The link will be in the description, and obviously you can kind of work out for yourself what it is you might do during the recession as well. Listen, I hope you found this video useful. I'm going to end it here. Enjoy your weekend. Go get a drink, and at the end of the day, we're going to be back here next week, you know, seeing what the market has in store for us, which I don't think is going to be pretty. If I'm brutally honest, I don't think it's going to be that pretty. But you know, this is what we do. Other than that, take care, have a great weekend, and happy investing. Peace.